Hi, I'm Bill Blain, strategist with Shard Capital here in London. We really have some extraordinary market conditions at the moment. Global interest rates look set to fall further. Global bond yields are looking extraordinarily low. Stock markets have been wobbling for the last few weeks, brought down by tech stocks getting examined by antitrust legislation, but also concerned about the lack of profitability in some of the names. It's a very interesting market, and where do we go from here? Well, at the moment, the markets are discounting some 70 basis points ease by the Federal Reserve. That's 3 eases before the end of the year. This is at a time when we were expecting the global economy to recover, but of course, now we have all the concerns about a trade war or even a long-term Cold War between China and the US. As a result, we have Fed members talking about the need to possibly ease policy. Through the rest of this week, we'll be getting more Fed members talking on the same theme. As a result, stock markets are watching very carefully. And the basis for that is that the stock markets believe that if we have further easing in the US, then that will be a signal for them to rally again. Remember, stock markets have lost most of the gains that they've made so far this year, and an ease in US policy would push them higher. But what does that really mean for global markets? Many people suspect that deep down it causes further distortion. It looks like the Fed would be responding to Donald Trump's urging for lower rates to sustain the long-term rally that has now been going on for over 10 years in the US. At the moment, interest rates are so low that it's enabling corporates to go out and borrow money which they're using for stock buybacks. But low rates also mean that corporates that are close to over-leveraged are not suffering any financial penalty for over-borrowing. If rates were to rise, it would certainly cause an increase in the default rate. Yet, with rates so low, the markets look terribly distorted. Add on top of that the long-term consequences if we really are going to into a global Cold War with China. If we were simply having a simple short-term trade war, yes, there would be a readjustment to tariffs being imposed and one side would give in. But this looks more like a long-term reassessment of global supply chains, and that has fantastically complex implications, not just for the US, Europe, and the rest of the world, but also for the long-term value of all securities. At the moment, we're poised at a very interesting place. Stocks still look weak, bond prices look to be overpriced, and we don't know where we go from here.